Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. This lesson is presented in two videos. 1. Accounting of uncollectible receivables, and 2. Accounting of short-term receivables. This second video illustrates the accounting of short-term receivables. Please review a description of the problem on accounting of short-term receivables that we are going to illustrate. It will be helpful to have a printout of the problem for reference while the problem is being worked out on the whiteboard.
This is the illustration on the short-term notes receivable and its related interest receivables, and finally the collection of the note and the interest. A short-term notes receivable is a note that matures within 1 year or less. So here the given information is, on May 1st of 2023, company loaned $10,000 to company B in exchange for a note. So here I'm going to put up the journal entries for these transactions. So first, the date. And then we have the accounts, and then we debit and credit columns. So first, May 1st, company A loaned $10,000 to company B in exchange for a note. So on May 1st, you debit note receivable for $10,000 and credit cash $10,000. Now this note, the interest on the note is 12%. So when they quote the interest, it's always for 1 year on an annual basis. So the annual interest rate is 12%. The note matures on October 1st of 2023. So that means the company B will pay back the money and all the interest on October 1st. The loan and the interest will be paid on the maturity date. So here the interest is 12% and the note matures on October 1st. So this note, the term of the note from May 1st to October 1st is for 5 months. So second one, so first, May 1st. Okay, now what happens between the May 1st and October 1st is there are the quarterly accounting period is ending. So one is on June 30, the end of the second quarter. Another one is on September 30, the end of the third quarter. So the company has to accrue the interest on. Remember, adjusting entry to enter the accrued interest revenue. So on June 30, okay, you have to calculate the interest. So here the interest is 12%. Okay, so the interest accrued on June 30 would be, so the note was made from on May 1st, you are entering on June 30, so 2 months have passed. May 1st to May 31st, May 31st to June 30 for 2 months. So interest accrued on June 30 would be $10,000 is the note amount and the annual rate is 12%. So that gives you $1,200 annual interest for 1 year. So for 1 month, it would be $100. So $1,200 for 12 months, therefore $100 for 1 month, and this is for 2 months from May 1st to June 30. So it will be $200. So this is the interest accrued from May 1st to June 30. So here you debit interest receivable 200 and credit interest revenue or interest income 200. And then September 30. Now we have to accrue for the second 3 months from June 30 to September 30. So for 3 months, if it's interest $100 for 1 month, therefore for 3 months it would be $300. So here again you debit interest receivable 300 and interest revenue 300. Okay, the note is maturing on October 1st. So on October 1st, Company B is going to return back the note amount of $10,000 and all the interest it owes to Company A. So here, the Company B is going to pay this $10,000 plus this $200 plus this $300, so total $10,500. So for Company A, so you're doing for all for Company A. So Company A is going to receive $10,500 cash from Company B. So you debit cash for $10,500 and then it's collecting the note. So you credit note receivable for $10,000 and then the total interest receivable is $500. That is also collected. Therefore you credit interest receivable $500.
Before we close the first video on short-term receivables, let us review the concepts behind the problem we illustrated.
Now we are coming into the short-term notes receivable and the interest receivable related to the short term. What is a notes receivable? This is a return agreement to collect a specified amount of money at a particular date. So here we are learning to account for the short-term notes receivable. That is the amount that will be collected in future but within the next 1 year. What is a note? So here there are some elements of the note or some factors of the note. First, the maker. So the maker, who is the maker of the note? This is the borrower, and this borrower is the one who makes the note and signs the note. So for the maker of the note, this will be a note payable. Now the payee. For the payee is the lender who gets the note receivable account. So here the payee or the lender, for that person, the payee or the lender, this is the note receivable. So we are going to see the notes receivable and the interest receivable from the payee's perspective or from the lender's perspective. Principal. This is the loan amount borrowed by the borrower or by the maker. Interest. Interest rate for the loan amount. This is usually specified at an annual rate. Maturity date. This is the date the loan and interest have to be paid, and this date for short-term notes receivable will be within the next 1 year. And the maturity value, this is the sum of the loan amount and the interest for the loan period.
Thank you for watching the video. We hope we were able to help you understand the accounting of short-term receivables. We have video lessons with worked-out problems on all topics of financial accounting. Please do not forget to subscribe. We hope to see you in another video lesson.